Welcome back to Mental Mondays. My name is Amar Varma, the co-founder and CEO of Mental. Today, I'm joined with a longtime friend, colleague, and elite entrepreneur, Karthik Ramakrishnan. Nice to have you.
Yeah, thanks for having me, Omar. Good to see you again.
We're going to tackle one of the biggest questions that you're set out to go solve is, in the world of AI, how do you convince enterprises to use it? And then in behind there, we'll walk through your product offering. What is insurance for AI? For those who don't know you, provide us a quick introduction on yourself and specifically what is Armilla and how they should think about it.
My name is Karthik Ramakrishnan, CEO and founder of Armilla. We essentially have built one of the first insurance products that covers the liabilities and risks of AI systems. It's a whole new category. The way to think about us is just like your insurance provider for your cars, for your homes, and now for your AI systems. That's what we do. We underwrite the risk of AI.
For folks meeting you for the first time, give us a quick snapshot. Who is Karthik? And what's the arc and winding path in life that's brought you here?
How much time do we have? An entrepreneur, technologist, immigrant, went to University of Waterloo, and then stumbled into a startup 23 years ago in the telecom space. And it was a great company, one of the dot-com survivors, called Redney, and we went public. It was an introduction to startups at that time, and I thought every startup would be this way. Like, you do good things and you go IPO, and the company's a success. But after that, I started building my own companies with that belief. The first one was a mobile advertising platform back in the days when apps were just starting off. Funded by Extreme Labs, which went on, and we exited to a gaming studio in the Valley. But also was my first foray into machine learning. So 2012, when the breakthroughs happened, I'd always been interested in machine learning. My master's thesis was all about probability theory. But when I started working, I was like, I have to work with the technology. We built a platform which could look at digital properties, so the activities within digital properties, mobile apps, websites, and then predict user actions. Today would be called an AI company. Next best action platforms are all the rage. And we did that back then. We have clients like Kobo, which is a Kindle competitor. New York Times was a client. And what we did was we could inform marketers and product managers what their users were doing, right, in the funnel. Who was going to churn, who was going to be more active, who was monetizable, and they could take action against that information, which is great. But if we think data is a problem today, imagine 2012, where no data was ready for machine learning. We spent 80% of our time just cleaning and managing data, and only 20% of our time training the model. So scalability was an issue back then. And so we ended up exiting to Deloitte. Joined the analytics team, helped them set up their AI practice. This is 2016 when AI was just starting off. Spent a year with them, and then got an opportunity of a lifetime to work with Dr. Yoshua Bengio, who is one of the godfathers of modern AI, at a company called Element AI that was started in Montreal. It was around the same time as OpenAI that we started, perhaps, but we took a very different route, very commercial, and we were one of the premier companies back then when most of the world wasn't talking about AI or artificial intelligence at the point. We're building some of the first applications to companies like Toyota, HSBC, Canadian Tire, retailers, insurance companies across the board. And that company exited in 2021 to ServiceNow to become their AI research arm. And on the back of that, I started Armilla AI because of a problem that we saw while working with clients there. The fundamental problem for enterprises was not the fact that AI could do magical things if it worked. It was the fact that what would happen when that system failed. And failure is by design. And what does failure look like in AI systems? It's the fact that it's never 100% accurate. There's a level of uncertainty in every prediction. The best model can reach like 95% accuracy, perhaps, but there's a 5% of uncertainty that it doesn't work. And that comes in technical things like drift, the data changes, the machine learns something new and starts going off the beaten path in terms of its predictions. It looks like hallucinations in Gen AI models, right? It looks like bad price predictions in a retail model. And that can happen very quickly. And so enterprises, even today, are very worried about deploying these systems because of that error rate and the unpredictability of that.
Let,
So
let's let's
Armilla,
let's
yeah,
yeah, let's pause you right there because I think there's a couple of really key things you said that I think we should bring all the audience up to speed here, and then we can jump right into the Armilla piece on this because it's a great segue. Look, I think there's some flowers given to some people here. I remember Lucas Skachkowski starting Redknee. I heard about this guy. Company went public. It was an incredible story. A lot of alumni and friends of friends we all know ended up getting their teeth cut there in their next chapter of their career. It was really awesome. You talk about Kobo. Mike Zerbinus is a great entrepreneur, generational person as well. And just seeing these people get flowers, and you went to Element and worked in that ecosystem. So you've been around a lot of very, very, very successful and very high performing teams in technology for decades now. You yourself are that ilk as well. I think what's super interesting when you talk about some of this stuff is one, the adoption of AI in enterprise when you were initially starting to do it versus today. That'd be a nice contrast. And then kind of the AI really took off when OpenAI figured out to have a text box for you to do something and get something of value back. That really spawned a lot of this whole innovation thread. Maybe talk to some of the adoptions you've learned because you've worked both in consumer and enterprise over the years, and kind of then dovetail that into some of the Armilla stuff.
yeah. I mean, yeah. Thanks for reminding me. There's been some amazing folks that have had the opportunity and the privilege to work with. But at the same time, being in the arc of AI from like 15 years ago, what it was to what it is today, and you're absolutely right. It was the chat GPT moment when my mom could understand what AI could do, right? Up until that point, every model had to be hand cranked. It had to be trained from scratch with the data that is proprietary to that particular use case, to that domain. Everything had to be figured out. And then the product had to be built around it, right? It's not just a model working. And ChatGPT was that moment where you had a general purpose technology type model that had a baseline that you could just add a little bit more data and get, or even without data, extract a lot of value out of it. Um, but even then, that technology was transformer technology, which had been around for 4 years before that, was really getting to work at scale. And the massive amounts of information that was fed into the first GPT to become ChatGPT. And I think today, even that risk of hallucinations is not stopping companies from deploying AI because the the unlock from what it could do to now applying it to different use cases just off the bat in different domains. Enterprises are falling over each other to get to the finish line of becoming an AI first company, right? And I think it's not just about a single model or single use case; it's agentifying the entire company. And we were talking about this in 2016, 2018, where we didn't call them agents at that time. It's basically our theory was a self-driving organization. That's what we're heading towards,
Yeah,
right?
look, I think for all those Unix users out there, it was essentially cron jobs, cron tasks that are capable of assembling and kicking other jobs and tasks off, right? Like this was kind of the whole thing. Maybe let's dive right into Armilla. Like you talked a bit about the the drifts, the hallucinations, the reasons that people don't have trust jelly beans sometimes at the enterprise level. Enter Armilla. What is the key piece there?
Um, so today, Armilla, we've created, I want to say, a whole new category of insurance where we underwrite the risks and liabilities that comes from those failures of AI systems. Now, why is that important? Most of the insurance policies we have today are the risk factors that we look at to evaluate that risk and underwrite that risk is based on human endeavors, human activity. And in this future world of agentic activity, autonomous activity with no humans in the loop, how do we, first of all, understand and price that risk? That's number one. How do we build actuarial models and risk factors these new things that need to be developed? And then third, we need to price that. It's not even about an insurance policy. It's even just pricing that risk or an underwriting to it was the first challenge. Then the second challenge is structurally, how do you put that product out? Is it going to go into existing insurance products, like your cyber insurance, your technology errors and omissions, your DNO, ENO, GL, across the board, all of these get impacted, right, by this new risk. And our theory was, or our hypothesis was, at the very least, these products need to be repriced, A, and the language in the policy documents needs to include a specific coverage for AI, for those new types of liabilities that are coming through. And what
So
we
let
realized
me
was,
be
yeah,
there when you say, like, there's a lot of acronyms in there. E&O is errors and omissions insurance. D&O is directors and officers insurance. How is AI changing the fundamental risk of those things? I think this is really clever and worth digging and clicking into, or further refining the prompt here.
yeah, excellent point. Let's take two examples, right? Let's take general liability insurance. Every company has general liability insurance. As of January 1st this year, general liability standard forms have introduced an exclusion for AI. So typically, what does general liability cover? It covers things like bodily injury. So someone gets hurt by the activities in your facilities. It covers property damage, right? So you have a leak, or your software, for instance, creates some kind of property damage. And property can be loosely defined as software property, physical property, etc. It could be media and advertising injury. So things like a deep fake came out and impacted someone negatively. There's a liability to that company that can, if they get sued, their general liability policy steps in and covers for those situations, whether it's a lawsuit, whether it's a financial damage, whether it's, you know, different outcomes or harms that are caused. General liability has now put in a blanket exclusion for generative AI systems, AI in general. So now, if your AI system causes a bodily injury, a physical damage, advertising injury, you have no coverage on that GL policy, right? That's one example. And that's a hard exclusion. 50 different insurers in the US have now adopted that language, right? And so they may deploy it, they may choose to use it or not, but they've submitted to the regulators have approved it. So now that exclusion is out there in the market. Second example, your cyber insurance. Everyone who's in the technology space knows that you have to get cyber insurance. Cyber insurance covers things like if you get a breach in your system, right? So someone maliciously attacked, got into your system, stole your data, caused your systems to crash, ransomware, right? So held you hostage. Your cyber insurance policy steps in and covers for those damages, right? If you have to pay the ransomware insurance and cyber pays for it.
This started out as a nice letter from a prince from a faraway country wanting to deposit money on you, and it become incredibly sophisticated over time, and has accelerated tremendously in the last couple of years with the AI capabilities, where it's not just things you get in your inbox that look better and better and tighter, but now it's a surface area that has infinite space, where there's no downside for somebody to try, because they have
Exactly.
resources. It's very interesting.
So let's pick one coverage in that cyber insurance policy, which is privacy. So if you have a privacy breach, right? You lost your customers' data. GDPR, the EU GDPR Act, Canada has one, US has one. Similarly, you are liable for your customers' data, right? And you had to compensate the damages that happen as a result. Now, that is triggered, that cyber policy is triggered if you had an external threat actor, a malicious actor coming in and stealing that data. What happens though in the scenario with the AI system where it inadvertently releases private information? Highly possible. It has happened. There was a case of some HR company was doing a presentation. They asked the system to create a use case of an incident, in an HR incident. It actually picked up a real incident of an employee in the company and put it up on the presentation. Right now, that person's that privacy has been breached. Right, no threat actor involved. Your cyber policy may not step into that. Right, so you're not coming into these edge cases with AI where do you have coverage, or does your existing policy provide that coverage is a question mark. And that's why you need to have clarity, right, around that. What if your AI model is biased in some way, right? It made some discriminatory predictions or conversations, or in insurance, you're not allowed to discriminate on price between different criteria. What if your model inadvertently
There's a lot
became
of
biased?
There's a lot of stuff in here that I think is specific to insurance, and if you've been through enough and done enough in life and business, you've seen all sorts of policies and you can really understand. But maybe let's dial it back just for somebody who's like, insurance, like how it's the most boring, exciting thing, right? Like, so what is an insurance policy? How is it priced? And how are you impacting this?
Okay, let's go to the 101, right? An insurance policy essentially is a protection for when Murphy appears. Murphy's law, something goes wrong. You don't plan for that. You don't expect that to happen. But when it does happen, what protections do you have? Let's take it. But by the way, insurance has been around for like thousands of years, right? From the Hammurabi Code in Mesopotamia, where the Hammurabi Code in the Middle East, there's actually tablets, stone tablets which have insurance policies in there. So if
It's
your
amazing.
crops did, yeah, exactly. If your crops did not come in, the king would step in and pay you a coverage amount. Ships. Lloyd's of London, the biggest insurance system regulator that we have around, started trade with ships going through would not happen because let's say you have a ship going to India and picking up spices, and there was a storm. The ship disappeared. All the investors who put money to get that ship to India, bring the goods back, would get money back from that. All that property was lost. The investment sank, right? Literally. What's your protection? So literally, Lloyd's was a coffee shop where these traders would come in and they say, I am taking this ship to India. I'm going to come back with these goods. The value of it is going to be so much. Who can provide some insurance coverage if that ship sinks? And literally, people would go up and write their names to say, yeah, I think this is good. And they will underwrite. The word underwriting came from there. They will write under each one's name, signature, saying, I'm going to support this endeavor. And here's how much money I'm going to pay if it sinks. But if it succeeds, you give me some premium from the profits for taking that risk on. Right. So every human endeavor has been supported by insurance from day zero. It's for those events that you cannot predict. Right. And the job of an underwriter is to understand how something could go wrong, the probability of it going wrong, and then saying what's the damage involved if it does go wrong. And so between that, you figure out how much premium you would charge someone. Right.
Got it.
And
I
I
think
get
it's
paid for that.
fascinating. The construct of underwriting and the history there is super cool. Let's switch up a bit. Two topics I wanna get through. One is cracking the enterprise sales code with AI. We'll get to that second. But first, what are AI founders and what are things that AI founders and AI teams, even at companies, how should they be thinking about it with respect to their product? What are they getting right? What are they getting wrong? And what are some of the key learnings here?
So, you know, today we're in the stage where creating software is almost child's play, right? A 6-year-old could open up Claude Code and build software. But do we actually know how that software is being built? We don't. When there's thousands and thousands of lines of code that can get generated in 6 minutes, right? You don't have the time to go through all of that. So you created a product, it works generally, you've tested it, and you put it out there, but you also do not know all the nuances of what the model has learned or not learned, and those edge cases where things can go wrong. So in enterprise, that trust building is absolutely critical, right? Because when an enterprise buys, you have different buyers, right? You have the economic buyer, you have the product buyer who's interested in the value proposition of the use case, but then you also have legal, finance, procurement, risk management, compliance, who are all looking at the downside risk of deploying that technology. And so where initially, we don't think about, no one thinks about insurance as the first thing for anything, right? Insurance is seen as a tax. Like no one wants to buy insurance, but you have to, right? But the value of insurance only shows up on those days when something went wrong. And now if your code creates a problem, the downside risk protectors of an enterprise are looking for some sureties, some guarantees that they're protected when things go wrong. Right? That's why they make you buy cyber insurance. So what AI founders are doing now is they're not thinking of the other side of the trust equation. It's not just proving with a better demo or all the different scenarios that you've tested the model with and giving proof points. It's also saying, hey, listen, I understand this thing could go wrong, and I have proactively gone and obtained this insurance, and that's what we're seeing now. Saying, look, we know there's some gaps and there's some liabilities that are specific to AI. We have thought about this. So an enterprise buyer now has a confidence in that startup, in that vendor to say, these guys are thinking through the problem, right? And coming to me with a structural solution, not just say, believe me, this thing works.
Wow, there's a lot in there. We're sitting in June 2026. It's I use open source as a previous genre of this. Open source software pervades was pervasive. It became part of every installation and application. I'd suggest a good majority of software is now being integrated with some tools that are auto generating or creating suggestions to the code base. This is very interesting because without the knowledge of what it's doing and how it's doing it, you're having to sign on the line of, that it's okay. It's very, very fascinating.
Yeah, and then now it comes down to how do you understand that risk? Like from our perspective, we've taken a very close look at hundreds of systems and use cases and domains, financial services, healthcare, HR tech,
And how
legal
do you
tech,
do
all
this?
of that.
Do you put a harness on there, or like what exactly are you doing?
So a good company, right? So when we talk about the structural solutions, right? You've not just created the software, you're not just created this AI solution, you're also putting in good governance in place. So we expect our insureds to have the best controls, policies. Are you compliant with something like ISO 42001, which is a governance framework, or NIST standards, which is what even the current administration is signing off on, saying one should comply with or follow the NIST compliance for AI, right? The National Institute of Standards and Technology in the US sets standards for many things. So when you get those certifications, you are proving to us as an insurer that you're taking all the right steps to protect when things go wrong. Okay, great. But still, things can go wrong. We then price to that risk, saying if it's a legal tech solution, a lawyer used the solution. There's every day there's a new case of a lawyer using ChatGPT to go into the courts, and the judge says, "You use ChatGPT. This case law is wrong. It doesn't exist. It's made up." Right? And what happens in that case? Their reputation is gone, the client is gone, and maybe their business is done as a result, right? Because of something that they don't know, but they're doing it at volume has now created a problem for them, which they weren't even aware of. Now, all of that to say, we then price for that. So, what's the probability in this particular situation of the model going wrong? What steps has the company taken to protect against that downside? And then we can come up with a price and say, here's the insurance, right? We could take the case, a practical example. This is a company that builds agents, right? The agents does prediction for sales, call centers. It's a chatbot. It's got a voice system to it. Now, if it starts giving wrong outcomes, and this happened with Air Canada, where the chatbot gave wrong advice to a consumer, the consumer then sued Air Canada, and the court said you had to pay, you had to side with the consumer. And
Yeah.
Air Canada tried to say, "No, this is not our problem. The chatbot created it." Court said, you, Air Canada, are responsible for that chatbot, right?
Yep.
And Air Canada is also right. Like they didn't create each one of the responses. It's coming up. The chatbot is coming up with those
Everybody wants
responses.
the upside without the potential of downside in life on things. They're not willing to own the take, right? Let's kind of get a bit specific here. One of the things that's happened in some of the products is, you deploy something, it's great, it works differently tomorrow. Next week, it's working very differently, and you're getting this drift. We've seen it in some of the stuff that we've been working through. What advice do you have for people building on how to kind of understand drift and how to make it a thing that's not a liability, but possibly an advantage?
Exactly. There's many solutions out there, right? Monitoring for this, right? So monitoring the outputs of your system in an agentic way as well, right? So every input and output interaction, you want to verify that before. It's not possible with humans at the scale at which these agents are going to work. So you need to have a solution that helps you at least sample size, detect drift. There's many ways to detect drift. You can detect the drift at the model level, at a data level, and there's tools available to you to use that. If you're on Google, Google has its own out of the box ML ops systems, right, that help you detect that. So we should be thinking about that. That's one. Two, controls. Like when you do detect drift, how quickly do you take action? What is your remediation plan, right? When something goes off the rails, that you step in, who's in charge, who steps in, fixes the issue, how do you take the model offline, bring it back online? There are many things you need to think about. And so when you've thought about this and you've got these sort of controls and policies in place, that makes you a very strong risk manager for the enterprise when they buy from you.
What's some advice that you think would have been helpful to have gotten 2 years ago or 3 years ago?
Wow. I got the useful advice. I didn't take it.
Break it
Which
down.
was they said, don't do insurance. It's the hardest thing ever to do, especially when you're creating a new category of insurance which has zero data in the background. Right? This is the first time this product's being deployed. I didn't take it because this is what I wanted to do. I think this needed to exist. This needs to exist. It's been hard. To convince insurers, risk capital to step in behind us, give them the confidence that we know how to underwrite this, to create the models, and then unlock the millions that we have now in backing. That was it was a grind for 2 years, but here we are on the other side of it. So I'm glad I didn't take the advice, but also maybe I should have. It has been hard.
If you're not doing something hard, what's the fun in it, right? So that's interesting. And then what would you give as advice to people that are in your spot from 2 years ago?
It would be the same advice. Do hard things. Doing hard things, the impossible things, is worth the time. A lot of entrepreneurs, like, I don't know, I mean, I wouldn't generalize, but many folks are like, I just want to create something. I want to do it quickly. I want to ramp up quickly. If I'm a year or 2 years from revenue, right? Those are the opportunities most people are working on today, right? Hey, in 6 months, I'm now at 1 million ARR. That's happening today, right? Because I can create the software very quickly, get it to market, and I'm there. But those are easy things because it's been made easy. The ones where it's hard structurally because the domain is hard, the problem is hard, it's physical, it's structurally as a supply chain, things are hard. Cracking that nut actually gives you a competitive advantage. It's hard, it takes time, but once you crack it, you created something of value that it would be very hard for others to do, right?
There are structural moats that people can get, and sometimes that moats are sometimes money, sometimes distribution. The structure piece sometimes is in there, and it's like some people can see it from a mile away. It's like a three putt to get it there, triple bank to get it there. They just get it. Sometimes doing more than one at a time is considered to be impossible, but sometimes getting those multiple things to happen creates an infinite opportunity, and it's what I call the 0 billion. The market is worth $0, but if you can make the market, it's worth billions, right?
Billions,
That's
exactly.
kind of the
Right.
opportunity. Let's go through a couple other things. Enterprise sales is hard. Enterprise sales has gotten incredibly hard in 2026 because what worked for the era of SaaS, gone through what I think people dubbed SaaS apocalypse, where nobody's using any more software, and the reality is people are moving to using more software. These form factors just changing. Some things are headless, some things are native and tied inside of other platforms. Maybe just talk about how to earn jelly beans and what was the unlock for you in getting your first enterprise customer to trust an AI platform.
Um, it was a lot of things that we talked about, right? Which is you're thinking about the problem holistically, of how the enterprise thinks about the problem. It's not just, again, cracking the value proposition, but what is it that you're going to do above and beyond just the software that differentiates you from the competition, right? As you said, today, starting a company, starting a product, the friction is near zero, right? To get something out there. So when you have this volume, how do you stand out and apart from the competition? A. B. You're going to do that by convincing the enterprise that you are doing something different than what your competition is doing, and what is that? And there's no general answer to it, but you have to crack that for what it is for you. I'll give you an example of one of my customers. They have a platform that predicts that does credit valuations, right? And they give out loans, consumer loans, right? Building that model is not hard these days. You can do that very quickly. But the real trick there is, how do you write good loans, right? So that you're not losing money on the loans that you underwrite. That's what their backer, the credit unions, the banks that give them the money, care about. What these folks did is like, hey, we're so confident about our software that we're putting a warranty behind it. If there are losses, we'll eat some of those losses. So now, not only are you saying my software works, you're proving that by giving a structural trust factor, right? We trust it so much that we will cover some of these losses, and we will take a position in your risk. And that has unlocked their business. They stand apart from their competition, and they continue to get more and more banks to work with them.
Yeah, that's a good use case for people to think through. There's a lot in there. I'll add a couple other things. Finding your champions, finding your buyers, in parallel navigating your way through procurement. Those are the other pieces. Talk about pricing. How do people think about pricing in this?
So this is I think the old seat-based pricing is going to go away, right? It's going to be value-based more and more. And this because the value that you're extracting is from the token. So the token cost is your actual cost now, right? And what you employ that token to produce as an output, what is the value of that? And you have to price to that, right? And it'll vary by use case. But I think the old propositions of monthly fees and the set fee for every month that you're going to charge, that is yesteryear. And I think the ones that are succeeding today are actually participating in the value extraction for their client that they're producing, and then participating in that upside, right? I would say, if
So you're talking about outcomes?
we're talking about outcomes, yeah, outcome-based pricing.
Outcomes is the rose fully blooming on the previous model, which was perceived value. that was the now we're getting the rose fully bloom, saying, how nice is the rose? What are you willing to pay for that next rose? I like that analogy.
Can I add one more thing to something you were saying earlier? One of the things in enterprise sales is, and I read this book many years ago, there's a concept of a fox. This is the person who is not the economic buyer, who's not the roadblock, but has extreme influence on the decision. They're not the decision maker, but they have an influence of decision, and people look to them in the organization before making a decision. And this person can make or break the deal. And if you don't identify that person, then your deal is set to fail. You could have checked every box and find the fox.
This is so interesting, especially in these large multinational orgs, like getting to the committee of the committee. That's why you got to go top down, bottoms up, left, right,
sideways. Yeah,
you got to really navigate this. Let's kind of get to a couple of things and then kind of push to some of the fun rapid fire things. But talk a bit about your experience in YC. When we were younger, it would have been, for folks our age, it's kind of morphed and over time. And it's really the place where people get pushed to hyper growth, thinking global, moving fast, all those things. You didn't go as in between your undergrad and grad school. You went as an adult. So what was your experience like there as a seasoned, been through the founder grind? And what did you take away that was, I'm doing this well, and what was new of like, I learned this?
You're right. I mean, we're not the typical, profile of a company or a person who goes to YC. I mean, there are more uh, folks like me as well who went to YC, but that's not the majority. But to me, I think the biggest takeaway from YC and why I joined is it's like going to the gym, right? You may be running, but getting a trainer at the gym is different, right? And YC is the trainer in the gym who's pushing you, number one, giving you techniques that you may not be familiar with. So they expose you to so many different techniques and so many different areas that you may have blind spots, you may not be the expert at it, but then you also have a peer network that you can learn from at the same time. The YC network matters. Not just from a fundraising or a customer standpoint, even learnings between the founders. But to me, the biggest takeaway, and I think I'm so glad I did it, because YC said, I wasn't planning to do insurance then. We were actually just doing assessments, building that trust. We built a platform that can go test models and build that trust layer for enterprises. And YC said, if
It's
that's what you want to do,
type report,
yeah,
right?
there's software, and we still do that. I mean, but that gave us the data to underwrite, right? Like our experiential data around that. But what I learned at YC was they were like, if that's what you want to do that now. Why are you waiting to do that? I always felt we didn't have enough data. We need to do 10 more models. We need to work in 3 more industries to get a fuller picture of the risk before we can start pricing it and building the actuarial models to it. And it was that summer, right after YC, we shut our old business down. Or I don't even shut it down, but we pivoted hard into building our insurance company. And that was my biggest takeaway.
Very cool. Guys, get to some rapid fires, and then we'll get us to the end here. One thing AI founders underestimate when selling?
How much skepticism there is around AI.
Got it.
As you said, there's 10 solutions. They have lots of choices, and most AI companies have no history. They just started 6 months ago, right? More created every day. That lack of history. So there's many reasons for that skepticism, but you need to counter that.
Best use of AI you've seen that most people don't know about?
Oh, I don't know if I can talk about it. I mean, as an insurer, we get to see a lot of different use cases. And what our clients are doing because we get into the details to do that. But maybe I think the most innovative one was this credit lending company, right? How they used AI to price the risk, and it is performing much better than your traditional models. So it was not surprising, but it was a very good application.
One book every founder should read.
Built to last.
Why?
I think it gives you that long-term thinking, right? Of it's if you're building a company for a flip, or if you're building the company to sell, but are you building a company to last, right? That's generational. What are the methods? How should you be thinking about it? And it gave me a lot of my mindset around building a company for the long term. And you become more valuable as a result. Yeah, you may still exit, you may still have all of those opportunities, but they come in much better when you're building a company that's sustainable on its own merit.
And then finally, things people can get to know about some of our guests. What is it you love doing outside of your building?
It may sound trite, but actually, I obviously love spending time with my son. But then we do something together every morning. I cook, and we make breakfast together. And so I think that's my favorite activity, like all of the other things that I do.
Very cool. Well, look, thanks for your time. Hopefully, you felt like it was fun to share your vision of the world of insurance and AI insurance with everybody. And thank you for participating.
Thank you for having me. This is excellent.